Hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you how to collect a regular paycheck by trading options. And yes, it can be done. And no, it is not difficult. So if you're new to options trading or you're trying to use option trading to get that little extra income in order for you to maintain your 9 to 5, then you happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I'm going to show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how I sell covered calls consistently to make income. I'm going to show you in today's video how to get this done on a weekly basis in order for you to collect a weekly paycheck. Now, as usual, I will be using stocks that I do have in my portfolio and also strategies that I do use in my portfolio. But before we get into this, I always want you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. And favor number two, always make sure to have an exit strategy before entering any options trade. That being said, let's go ahead and get down and dirty with options. For today's video, the first stock I'm going to feature today is none other than Super Microcomputer, ticker SMCI. So let's go ahead and jump in the option chain by hitting Trade SMCI options down to the bottom. So I'm going to go ahead and make this video as user friendly and small account portfolio friendly as possible. Now, if you guys need any help with your portfolios, especially with trading to small account portfolios, I do offer a one-on-one consultation and also weekly classes. That link is going to be in the description below. Now, let's go ahead and get into the option chain. So, first order of business, do you actually know how to sell covered calls consistently to make income? Here is how it's done. You're going to first go to sell, then you're going to go ahead and go to call because you are selling covered calls. We're going to choose our expiration date. And I did promise to show you how to get this done on a weekly basis. So 2 days is a bit short. So let's go to April 11th, which gives us 9 days to expiration, just 2 days over 1 week. Now we're going to go ahead and we're going to choose a strike price. In order to obtain the maximum efficiency of this option strategy, it is highly advisable that you choose your strike price way above your share price. So we're going to go ahead, we're going to scroll up in order to look for a decent strike price that we're satisfied with. So I'm going to be going with the $37 strike price. Now with the $37 strike price, I'm going to have what's known as a chance of profitability. The chance of profitability here is going to be 75%. That tells me that there's a 75% chance that this trade goes in my favor. Now, if this trade does not go in my favor, I only stand a 25% chance of the trade going against me. However, this option strategy is known as a win-win option strategy. I'm going to show you that as the video progresses. So, with a strike price of $37, and a chance of profitability of 75%, we're going to be paid. The amount we're going to be paid is $1.05. Now, $1.05 in the option world equates to $105 in the real world. And that's simply because each option contract is multiplied by 100 shares. So you simply multiply $1.05 right here by 100 shares, and that should net you $105. Once we go ahead and click into it, we now showcase the strategy of selling a covered call. So let me break this down to you. So what you're doing here is selling a covered call by going to sell and call. You're going to get that done on a weekly basis by choosing a weekly time frame. And once that's done, right away, you're going to be receiving some kind of income. That income you're receiving is what's going to help you to grow your small accounts portfolio. Now, there's a couple of ways in which this trade could go. Now, come expiration date of April 11th, if this share price right down here of 33 goes past the $37 strike price, then we're going to now be forced to sell 100 shares. One of the most important criteria in order to do the covered call is that you must own 100 shares of the stock. Now, we're going to pretend that you're going to be buying 100 shares of the stock right now at this current price, which is going to be 33.33. So Once this 33 share price hits your strike price and it goes above the $37 here, you're now forced to sell your 100 shares that you just bought for 33.33. You're now forced to sell it at 37. Now, here's the good thing about this. I did mention that this is a win-win option strategy. So the first way you're going to win is that once you sell your shares, you're going to be receiving what's known as investment gains. Your investment gains is going to be your difference between your $37 strike price here. You're going to minus your $33 here, and that should give you $4. You're going to multiply that $4 by 100 shares. Once again, you are dealing with option contracts. So once you multiply that by 100 shares, you're going to get $400. In addition to your $400, you will be able to keep your options premium which you receive of the $105. So potentially on this weekly trade, you stand to gain $500. Now that is one win from this option strategy. Now let's go ahead and get into the second win. So once again, come expiration date of April 11th, if this share price does not go past your $37 strike price here, then you get to keep your 100 shares that you bought at $33.33 in your portfolio. And once again, now you get to keep your $105. So you win if the trade goes above $37 by being forced to sell your 100 shares, and you get to keep your premium. You also win if the share price does not hit $37. You get to keep your 100 shares and you get to keep your $105. Hence, a win-win option strategy. Once you do this on a weekly basis, you're now able to collect some premium. This trade does not have to be managed as much as other trades because no matter how the trade goes, you still win. And that is how you use the covered call option strategy on a weekly basis in order for you to collect an additional paycheck. Now let's go ahead and jump into the second stock I use in my portfolio in order for me to make consistent income. And for that is going to be IONQ. Okay, so here we are on IONQ, ticker IONQ. And once again, we're going to do the exact same thing, which is going to be sell and call. And we're going to be going for weekly expiration dates, which gives us April 11th, 9 days. Once again, we're going to go ahead and we're going to choose a strike price above our current share price. And we're going to be going with the $27 strike price right here. Now, once again, we're going to be assuming that we bought 100 shares at $23.84. Let's round it up to $24. Now, our chance of profitability on this one now is going to be around 76%. So, $27 strike price, 76% chance of profitability, and the income we're going to be receiving into our portfolio is going to be $1.02. Once again, that's going to be $102. Now, I want to bring something to your attention. We're going to go ahead and we're going to click into the strike price, and that's going to open up what's known as our secondary option chain or the Greeks. So I wanted to bring something to your attention, which is going to be your implied volatility right here. Your implied volatility tells you the riskiness of the stock. Depends on the riskiness of the stock. It tells you how the stock fluctuates in an upward direction or in a downward direction. Now, the implied volatility right here is 116, which is very high. So just as an analysis, any implied volatility when selling options between 50% and 100% is that sweet spot when I'm selling options. Now, any volatility of 100% and above, that goes into really risky territory. So you can actually trade these high implied volatility. However, you just need to be more careful and need to manage the trade more often. Okay, so once again, in maintaining that weekly paycheck from options, this is how this could go. So we did say we did buy 100 shares at $24 per share, and now we're going to be selling at $27 if our strike price is hit come April 11th. If that happens, we're going to get our investment gains, which is going to be the difference between 27 here and the $24 per share we paid, which gives us $3. We're going to multiply your $3 by 100 shares, and that's going to give you $300. In addition to that $300, you're also going to be keeping your premium. Every time you do this option strategy, this premium you receive here, although it looks very small, it compounds over time, and that is what you use as an extra paycheck, and that's what you use to build your small account portfolio over time. Remember, this is a win-win option strategy. So no matter how it turns out, you stand to win. So, anyone trading with a small account portfolio, you should highly consider using the covered call option strategy in order for you to get a regular paycheck, in order for you to add to your regular 9 to 5. Now, if you guys have any questions about the covered call option strategy, how to use it to get an extra weekly paycheck, then let me know in the comments below. If you guys are using any of these stocks in your portfolio, like I am, which is IONQ, or SMCI, let me know in the comments below. Now go ahead, like the video, subscribe to the channel. But most importantly, if there's anyone out there struggling to grow a small account portfolio, then feel free to share this video with them. Let's help as many as we can. And until the next video, keep pushing your investments.